Hello and welcome. This is Stocks to Watch on BloombergQuint. This is where we take you through three sectors of stocks which are in focus, and we take them up with experts. And today we have with us Anand Tandon. He's an independent market expert. But before I go across about the stocks we want to address today, and well, right at the top, we want to address the sector that's the cement sector, which has been quite active of late. We have Coal India's production and offtake numbers for the month gone by, and Ashok Leyland, where we've seen volumes come through. And on that note, let's talk about the first element today, and that's the cement sector. We have seen a lot of activity, specifically in the relatively smaller names. In the mid-cap space, perhaps in the small-cap space. So, of course, India Cement is a one-off, considering we have a very large investor come in. But if you leave that aside, we have the likes of Shree Cement. There has been a little bit of recovery of sorts in Ultratech and Ambuja as well, of late. But let's take this up with, Mr. Tandon today. Mr. Tandon, good morning, and thanks so much for joining in. Your view on the sector, and how would you go about picking stocks in this sector, if at all you would think it's a prudent way of going about investing right now?
Well, obviously, you are looking at a slightly long-term view, because this year is going to be somewhat muted, and you are likely to see a drop in profits for most companies. But that said, cement is probably one of the better sectors to be in, largely because it is insulated from anything that happens to the rest of the world. And consequently, in India, we have already seen many stocks performing reasonably well. The frontline top, large companies are the ones that have actually managed to gain market share consistently and continue to do so. No doubt they are more expensive. So, for example, an Ultratech would be probably one of the most expensive stocks in the country. But given that they have recently rebranded Century and added some more, taken over another company, overall you would expect to see their profits continue to grow, largely because not only of their improving of operations, but also because the rebranding exercise, etc., allows them to charge a premium, which comes more or less straight to the bottom line. So the frontline companies like Ultratech remain interesting. As you mentioned, some of the smaller companies are now attracting attention, largely because this quarter has been quite good. The raw material costs have come down, and therefore the margins are at an all-time high. And there I would single out companies like JK Lakshmi, where not only has the performance been good, but also the the valuations on a EBITDA per ton basis or capacity per ton basis are among the cheapest.
Okay. All right, so that's your view on the cement sector. We move on to talk about Coal India, and on expected lines, the production and offtake for the month gone by, that's June, has seen a decline. So when it comes to production, it's down around 12-13%. Offtake is down by as much as 15% in June. Mr. Tandon, let's take the larger picture for Coal India at this point in time and consider that as an investment opportunity. There is one pocket of the market which only thinks and takes Coal India to be a dividend play and nothing at all, nothing more than that. How would you approach this as far as the investment is concerned?
Well, Coal India has not managed to deliver in terms of being able to grow anything beyond 3 to 4% on the top line. Despite the fact that the coal ministry continues to put targets which are in double-digit growth and so on, either because of demand or supply constraints. Right now, it seems that the demand is somewhat muted because power demand has come down during the COVID period, and most power plants are now have coal reserves of almost a month, which is among the highest they've ever had. Consequently, you would expect to see that even the next quarter, Coal India will have somewhat muted demand. That said, the valuations are reflecting that and some more. So, as you said, it is definitely a dividend play, and from that perspective, someone who is interested in holding on for getting better than the bank rates nowadays, Coal India will obviously be attractive. One of the major problems that Coal India is going to face is the rise of this ESG investing, because most ESG investors, and that is something that's becoming more important, do not want to have anything to do with companies which are involved in carbon generation, and there cannot be more carbon generation than direct coal. So Coal India, to my mind, will have that will suffer that kind of problem, but you will see it moving, between the 100 and 200 kind of range over a period of time, as the in various waves that the market moves. So provided you buy it at a cheap enough price, the likelihood is that you'll make a reasonable return on it.
Yeah. And from there on, we move on to the final stock we want to address, and that's Ashok Leyland at this point. Once again, volumes, there's no point comparing them to the year gone by. Well, we have seen the total sales standing at around 2,394 units, and domestic sales were, well, a large chunk of it, as one may expect. There's been a little bit of an uptick, and of course, once again expected, or if you look at it on a month-on-month basis. But volumes have been slow, and this is largely because of the slowdown in the economy. Of course, the commercial activity has also been very, very muted. Mr. Tandon, would you take this time as an opportunity to start nibbling into some of these commercial vehicle manufacturers, or would you want to wait, take stock of the situation? Is there some time before we can start thinking about moving into stocks like Ashok Leyland?
So, Agam, let's look at the positives first. Ashok Leyland in particular has just completed a very large capex, and they have now a new platform, which is supposedly one that they can redesign in various ways, and therefore they should be able to offer a better product line to the market. That is certainly a positive. The other thing is their avowed interest in trying to reduce the costs and so on, which I guess almost every company will do. However, the major issue has been that HCV market has been shrinking dramatically over the last several years, and I don't see that changing anytime soon. So you are pretty much left with the LCV market for driving the demand and growth in the overall sector. And that is something where, because of the various improvements that the government has done, both in the form of GST and in the form of infrastructure, what is happening is the time taken for vehicles to deliver goods is fallen, and consequently the capacity has gone up. The second problem is, of course, the BS6 norms, which will make these vehicles more expensive. So I think you would find that you are going to have to sit on these stocks for at least a 2-year period before you begin to see numbers coming back even to what they were 2 years ago. And from then on, you can begin to see growth. And therefore, you have to time your entry at it when the market is really bad, rather than trying and buying it when it is euphoric. If you have to be in the auto sector, in my view, tractors, two-wheelers, and perhaps cars are the places to be.
Well, that's the view on Ashok Leyland. On that note, Mr. Tandon, we'd like to thank you for taking us through those three elements that we've spoken about. Thank you very much for joining in. And on that,
Thank you for having me.
on the segment, but there's lots more lined up. Stay tuned, Bloomberg.